Thanks for joining today. This is probably going to be the most experienced panel, if you look across the demographics here, that you will see at RWA Summit and probably any crypto conference. So I would encourage you to listen up, because we're going to both go through a history lesson on ETFs and also parlay that into current tokenization. And I really don't think you can find a more experienced panel group of panel participants here. Just brief introductions. My name's Casper, co-founder of Spartan Group. We're a crypto asset manager and investment bank based in Singapore and Hong Kong, with people spread around the world. And I'll just let the panelists briefly introduce themselves too. Rory, do you want to kick it off?
Rory Tobin. I used to run the global Spider ETF business for State Street. Before that, Barclays Global Investors, the iShares business, and before that, Goldman Sachs. So a full career in TradFi as opposed to DeFi. I'm learning a lot.
Roger Bayston, I head digital assets at Franklin Templeton.
Hi, my name is Jürgen Blumberg. I'm CEO of Centrifuge and CIO of Animoy, which is the white label platform from Centrifuge. And Rory and I, we overlapped at BlackRock. He was either my boss's boss or my boss's boss's boss.
All right, so Franklin Templeton, Goldman, BlackRock, State Street, a lot of relevant experience here. So let's start with the history lesson, because there's actually, for innovation in the financial industry and other industries, there's a lot to be learned by looking at, previous cycles of new products emerging. Obviously, tokenization is a new product, and we're going to talk about what the view is from institutions currently. But let's first take a step back, because a product which I believe is $17 trillion today, ETFs, which seems obvious to all of us as a product and like a no-brainer, back when it emerged was actually met with a huge amount of skepticism and honestly ridicule too. So Rory, do you want to talk us through that time?
Sure, Casper. I think, as you rightly say, the global ETF industry is now $17 trillion in assets under management. In the US alone, it's gathering about $1 trillion of new money on a per annum basis. And globally, we're growing in Europe, we're growing in Asia, et cetera. So the whole concept has really taken off. I see Jim Wyant here a little earlier on. If you go back to people who were involved in the launch of the ETF industry back in 1993 with State Street, nobody would have predicted that. And in fact, it may make people smile in this audience, but for much of the first 10 years of the ETF industry, and I was at Goldman at the time, I was in the equity derivative business, we were trying to engage and build this capability, working with people like State Street, et cetera. But for much of those early 10 years, there was a joke in the industry that ETF stood for empty time filler. When you had your day job, or when you had other spare time, you can try to figure out how do we get something done with this ETF industry. And why was that? Well, the reason was because when ETFs were first launched, there was a lot of complexity about what different people were doing. People may not know, but the original ETF came out of a recommendation from the SEC report that came after the crash of 1987, that it would be good to have a single security that traded a basket of underlying securities. And from that, State Street launched the ETF with the American Stock Exchange in 1983. But up until then, there was a lot of other organizations who had similar type of constructs. Think about multiple blockchains. But you had optimized portfolios as a liquid security, OPALs. You had World Equity Benchmark Securities from Morgan Stanley. You had country baskets from Deutsche Bank. So there was a tremendous amount of complexity. And we had to somehow narrow in the industry's focus to something that was called the ETF. That took a little bit of time. Bigger issues, though, were around things like education of investors. And now it's kind of crazy to say this, but in the early days, we had to spend a lot of time explaining to people, what is an ETF? How does it work? What's the creation and redemption mechanism? Where are the assets custodied? What is the cost? What's in the underlying portfolio? All that basic stuff, we put a lot of materials together. To be honest, to be fair, Barclays spent a lot of time on that investor education back in those early days and spent a lot of time on marketing dollars to make that happen. There was also a lot of time spent on regulatory engagement. I spent a lot of time in the early days working with different regulators around the world to educate them as to what ETFs were about. There was significant complexity to cross Europe, because Europe is a fragmented exchange, multiple exchanges, multiple currencies, multiple tax regimes. Will ETFs work, et cetera? A lot of time spent on that. And all during those 10 years, one of the things that we really were looking for was, what's the killer use case? And for a while, we were using ETFs for transition management, which was interim portfolios, holding securities, et cetera. The killer use case really started to develop in the late 90s when the dot-com boom started happening. You had the launch of triple Qs, you had the S&P 500, and the real use case was for equity portfolio managers who had cash in their portfolios and they wanted to minimize cash drag in a rising equity market. And that's when we saw people were stepping in to start using ETFs. We had the launch of the sector funds back in 1998. People got more access to different components of the market. And from then, the late 90s, ETFs took off. ETFs crossed $100 billion of assets under management at iShares in 2003. Once iShares had that capability, then it really started taking off and we created more access products, MSCI World, emerging markets, et cetera, et cetera. But the early years, investor education was critical, regulatory education was critical, simplification of the structure was critical, and I think also just creating a common infrastructure where people talk the same language was really critical. And I think today we're seeing some similarities in what's happening in DeFi space here.
Thanks.
Yeah, I think when I hear these stories, right, from the early days in the ETF and what I see now in the DeFi space, there is a lot of things in common. And I started in ETFs much later. It was in 2009, spent in total 15 years roughly within the ETF industry and predominantly focused around the liquidity footprint. And even when I started, which was years after the first ETFs got launched, the liquidity was still a major concern. And it was an ongoing room for education. So a lot of professional buyers, they had concerns around liquidity, which was visible on exchange, especially in Europe, where the market is so fragmented. And people were shying away from that, right? They said, how can I ever trade my 50 million, 100 million or more in one go if this fund trades on exchange, maybe single-digit millions every day? And it was this education around the primary market, the secondary market, how most of the volume, in particular in Europe, was done and is still done via RFQ platforms. And then over time, people got comfortable. And today, even in Europe, 1 billion plus trades are the norm, right? You see this every single day. Here in the Yeah, single trades, and even trades like 10 billion, they don't get the sweat on these price makers anymore. And I think there's a very similar journey when we look into tokens, especially RWA tokens, because the liquidity in the underlyings is there. It just needs to be channeled into the token execution, and it can be channeled into this tokenized execution. There are lots of liquid instruments out there which can be used to price tokens and make those liquid, with all the additional advantages that the token settles quicker and has far longer trading hours. But I think that's why the token, we talked before a little bit about private credit in one of the other panels, that's why I think the token is almost designed to add an additional liquidity layer, even for instruments which are hard to price in the real world. And I think this will be a great path for tokens really to succeed in the future.
Thanks. Roger, I'd love to hear your perspective and also maybe talk a little bit about what you're doing at Franklin Templeton generally in the ETF and tokenization space and how you view it.
Yeah, thanks for that. I think, first of all, the title of this conversation, ETFs versus tokenization, is kind of, I don't agree with that. First of all, it's ETFs and tokenization. I mean, our experience is just this tokenization buzzword is really about updating something that if you're in the securities-related business, if you have permission to issue securities, you are running a transfer agency function, regulatory approved transfer agency function. We have just upgraded the transfer agency functionality to use public blockchain as part of the database infrastructure. I mean, we boil things down into pretty simplistic terms. There's the have wallet, Web 3.0 digital wallet ecosystem structure. You have those, or you're going to want them. And the tokenization just delivers the current products and services into the existing and rapidly growing have digital wallet ecosystem. We know that digital wallets are growing faster than internet adoption grew 25, 30 years ago. I often joke that I'm head of digital assets. That's like saying I'm head of the internet department at Franklin Templeton. But really, we know that the rapid growth of that environment means that's where we want to meet customers. We're going to meet customers large and small there. So the delivery mechanism that gets there is this thing that we call tokenization, but it's really just upgrading this transfer agency systems and the operations to be able to use these blockchains so that now your shares are represented in a digital form that can be delivered into this ecosystem that is expanding. I mean, all over planet Earth, there's literally hundreds and hundreds and hundreds of millions of these digital wallets. And that's why we are at Franklin Templeton, we're really attuned to keeping our ear where the customer is, what they want. These are places where we want to deliver products and services.
And when you're talking to institutions, do they understand this? Like, do they also see it as it's a better piece of infrastructure, basically? Are they still kind of weary about tokenization, tokens, that the whole concept?
Well, there's two major things happening here. Our focus has been for a period of time here, getting the regulatory approvals to be able to meet customers there. There's still some hurdles to do there. I can talk about what we think a big transformational thing that would happen by the SEC, which would allow these things to happen.
That'd be interesting.
Because we do know that the have wallet ecosystem have broker-dealer operations prepared to move when they get the regulatory approval in the right environment in front of them. And that feels like that's happening weekly, quite frankly. I'm not going to move anymore. The second thing is, what we've already heard talking about, is the NASDAQ bringing all of their QSIPs in tokenized form. We have to, as asset management firms, consume these products in native digital asset form. That's a big transformation in custody relationships, a whole bunch of background, plumbing that happens that allow us to offer advice on something inside of a vehicle has to begin to happen. But we are positive, you hear NASDAQ doing that, we're likely to hear, the biggest issuer on planet Earth, which would be probably the US Treasury, bringing those assets on chain sometime in the near future. So those are going to be things that are going to transform, not only are there new types of assets, cryptocurrencies, which, by the way, we think crypto is capital, by and large. And so we offer advice on that in a number of different ways. All of this is massive change in the overall industry, from delivering products and services to consuming and offering advice around them. It's a really important time in the business.
And how are you finding, maybe question for you, Jürgen, in terms of from the institutional perspective, are they getting all this infrastructure and internal preparation ready so that when the regulation is there, they can move? Or are they kind of waiting for the regulation and then they'll move?
Yeah, so Casper, I think we are in a lucky position now with this partnership with Janus Henderson, that a lot of institutional investors, they find us, right? A lot of asset managers, private banks, others who are very curious about the topic, they proactively reach out to us and want to gain knowledge. And we are very happy to provide that. But we know as well, and I think Nick commented on that from his view as well, it's a very long process to get institutions to a point where they make the decision to execute. Right, so we consult, they involve more and more people, and then they start to KYC us, they get comfortable with us, and then eventually they execute and want to launch a fund on our platform, for example, or they want to bring their DNA in tokenized form to DeFi investors. And I think it's a long process with Janus. Thanks to Nick, it was reasonably fast. And I can tell you that there is almost no big traditional finance institution at the moment which is not looking into that. But I think it will be a long transition period, maybe something which was similar in the early ETF days.
It sounds like a lot of these changes are driven a lot by internal champions, like this one person who's just powering this through and then gets the board buy-in or the organizational buy-in. Was it similar back in the ETF days where somebody really had to just...
Well, I think that going back a little bit to what Roger said and then maybe what Nick said on an earlier panel, I think you've got to think about a little bit your question, Casper, is are institutions looking to adopt ETFs in a tokenized manner? And I think you look at the large buyers that, $1 trillion of new flows that we're now seeing in the US, it's fair to say that they're not screaming out for a tokenized version of an ETF. They're quite comfortable with what they have today, and what they have today works. It works well, and it's very efficient, and they're using that for all sorts of reasons. That's asset owners, asset managers, insurance companies, private individuals, etc. So what we need to do in this industry will be to think about how do we educate those investors as to what tokenization will be and what that will do for ETFs going forward. Then to what Roger was just saying earlier on is, but there's a separate community out there of wallet holders who don't necessarily have access to ETFs, who are interested in ETF formats and looking at, can they use the ETF as an access product, which is what the original use case was, and how do we create ETFs and put them on chain for those investors? At some point in time, those two worlds will converge, because the efficiencies that we're talking about, the NASDAQ announcement, the BlackRock announcement, et cetera, all of that will start to come together. But at the moment, there's still two very different worlds with different criteria, different languages, et cetera. There's probably somewhere in the middle of that Venn diagram an overlap. we need to create that overlap, and part of that overlap is getting TradFi and DeFi in the same room, but also I think there's a lot of work to be done on the investor education as to what this will mean for those investors ultimately.
And I think, so just from my point of view, as well to add that, I see at the moment this huge distribution opportunity of traditional finance into DeFi. And we heard Kevin before when he talked about kind of professional DeFi investors who need certain returns on chain. I think this is only going to grow, right? The capital on chain is now so sizable that it opens up enough possibilities and options for traditional finance to make their flagship strategies or to make interesting returns accessible for DeFi investors. And I think this will be, especially over the next months, will be very interesting for those traditional finance players to find a distribution pathway into the DeFi world. And I think this will be the first wave of adoption, and then over time, as Rory said, right, the worlds will converge and will lead to operational ease, will lead to the fact that all of these additional advantages like instant settlement or atomic settlement, 24/7 trading, that you have a full audit trail, right, which is ultimately great for regulators as well. That all of this will come over time, but I think it will all start with recognizing this distribution capability for far more TradFi players than it is right now.
And is there kind of a chicken and egg issue here where obviously the on-chain market now is relatively smaller, and for a lot of these big institutions, they just need to trade in size. So they're waiting for size, but then they're also the ones bringing the size. Like, how do you get the flywheel going on that?
Yes, I agree. However, look at the CLO fund, right, from Janice and our platform. This strategy has raised 800 million in just a couple of weeks. On any scale, this would be a tremendous success, right? If you launch an ETF and can get to 800 million within weeks, this would be big celebration. The distribution teams would be delighted and happy. The product teams would say, we absolutely hit the nail. So I think these examples, they really help to demonstrate what's possible. And it's still early days, and still we have a success story with 800 million within weeks. So think about what's happening maybe in half a year and 1 year when there are other DeFi investors, kind of institutional grade investors who express their demand. And then think about, as I said before, when, for example, private markets become accessible, and then ultimately when this operational ease comes to play. I think nobody in this room or even on this panel doubts that in something like 10 to 15 years, that most of the transaction will be on the blockchain, because that's how kind of innovation goes, right? But it will be starting slow and then speeding up, similar to the experience with ETFs as well.
I think it's worth talking a little bit about where you're seeing the use cases take off. So you talked about a little bit about internal champions, but I think from a client engagement perspective, they really need to see a powerful use case. And I think what's been done with Franklin, with Benji, other asset managers, money market space was somewhat of a challenge space in many ways. And now with tokenization, you're actually seeing steps where actually money market funds can actually be used for collateralization purposes. There's innovation we brought into in terms of payment of yield at different type of cycles, et cetera. So you're starting to see a pretty powerful use case in that. Maybe Roger can talk about, but that type of use case will then start to engage more of the traditional finance players, I think, to see actually, there's more functionality here. What was, dare I say it, a pretty boring product, not an ETF, but a pretty kind of stable, boring product for a period of time. Yep. You're now starting to see some very interesting creative innovation, particularly around yields. And I think that will provide, in a stablecoin world that doesn't pay a yield, the money markets are going to give people some incremental opportunities there. That becomes a powerful use case. So I'm talking about your territory.
Thank you for talking about that. Thank you for saying the word Benji. We didn't get that in the presentation yet. But that's true. I mean, there's nothing more boring on planet Earth than the U.S. government money market fund, right? And by purpose, by being scrubbed through various credit cycles, right? Including the global financial crisis. Which, raise your hand if you were somewhere in the business during the global financial crisis. The idea, though, that bringing that experience on chain and the composability of the chain allows for basically atomic settlement, instant transferability, and then the idea that you can break apart the 24-hour cycle into seconds and offer something like, we're offering intraday yield. So whatever part of the 24-hour clock that you hold the asset, Benji, you're going to get the yield for that, however many seconds you really own that. It's pretty powerful stuff, and I think that just speaks to what could happen if you bring things on chain. And now back to the ETF example, I'm struck by the fact that you talked about 1993 really starting. Well, that's 30-some years ago. Mm-hmm. And one of the things that is on our mind as it relates to the disruptive capabilities of the blockchain has somewhat to do with Benji, because when we're talking to the SEC about Benji and money funds, SEC has always been reticent about money funds because they've been worried about when there's crisis moments, everybody hits the gate at the same time, and therefore they can't, you can't convert the T-bills or unwind the repos into cash and deliver cash without, doing that at a discount and breaking the buck. Well, when we talk to the SEC, say, well, in this new ecosystem, we could press a button and give slices of all of these assets into the digital wallets that the clients already hold Benji in a digital wallet. They can have control of the collateral practically immediately. Now, my memory of the lessons of the global financial crisis was it's the collateral that you wanted, right? I mean, when somebody at AIG hit that button and sent the collateral to Goldman, it sealed two fates of two very large institutions. And so when we talk about these things, that's called in-kind redemption.
Correct.
Well, that has been the purview of only the ETF business now, but we know the blockchain is hugely disintermediating. And so if you are an intermediary inside of the ETF apparatus, it's possible that this tokenization actually transforms and/or is kind of the technology that replaces this giant machine called the ETFs, which has been so widely successful. I mean, just look on planet Earth about how many times technology then upgrades something and disrupts something that is, just interladen in everybody's lives. And I'm not saying that's what's going to happen here, but for sure, there's new technology, new opportunities that allow for in-kind, redemptions and/or subscriptions into all sorts of asset vehicles because of tokenization. And so I think there's likely to be disruptions coming forward in that space. Nothing ever changes. Nothing ever stays the same. Change is constant. That's an oxymoron.
And when you talk to the SEC about this, do they react in the way that you expect, as in this will help them sleep at night, it's a much better mechanism, or are they still kind of trying to figure out what to think about it?
Well, I think when we talked about to them, over the probably past 5 or 6 years, a lot of reluctance.
Right.
A lot has changed since the first of the year. And now they're really focused on things like, how do you get tokenized money funds to interoperate with stable coins, quite frankly? How do we reduce friction in that space so that these assets can migrate across each other and there can be utility for all of them? So there's new thinking and there's great partnership and collaboration because for sure there are massive geopolitical winds supporting all of this industry in the U.S. that didn't exist just months ago.
Yeah, that's a good point, Casper. Just to build on that is these conversations with regulators, they're never one and done. It's a multi-year process. And the reason I say this, because similar to what's happening in the money market space, coming into the COVID crisis of 2020, one of the biggest concerns that regulators had was the size of the fixed income ETF industry. And the view that many regulators had, whether it was the Fed, the SEC, regulators in Europe, et cetera, they were all massively concerned about what would happen if fixed income ETFs, if everybody started running for the exit door in a time of market crisis. And we'd all spent, I was at State Street at the time, with BlackRock, Vanguard, we all spent many hours, pretty much every year, doing it, walking them through what we called our liquidity playbooks, which would show what would happen if there was a run on these assets and if people did go for redemptions in fixed income. As it turned out in COVID, we didn't see redemptions in terms of what in the early stage. And remember, the market came off very bad, about 45, 50% in a short period of time. But what you saw was a new use case emerge in fixed income ETFs, where the actual fixed income ETF unit itself because it traded on a different infrastructure, on equity infrastructure as opposed to fixed income, which traded very much peer-to-peer, et cetera, you saw that liquidity of the fixed income ETF never dried up during the time of COVID. So the underlying portfolios weren't really disturbed at all. People traded the fixed income ETF, and you saw buying and selling in the fixed income ETF. And what ultimately ended up happening was the fixed income ETF became the source of price discovery for the fair value of the underlying assets. After that happened, interestingly enough, our conversations with regulators changed, because all of a sudden it was not what happens when everyone goes for the exit door. People didn't go for the exit door. It actually was this new use case around fixed income liquidity in the ETF space. And so we've changed it. Now the conversation from regulators is around private assets going into ETFs. So what happens, and that's a whole different conversation. There's also been conversations about other asset classes being wrapped in ETFs. But they're never one and done. It's a multi-year process with regulators, with investors to educate them about this. And I think the same will play out in DeFi space.
Maybe on this point, on the liquidity point, so when I was at Goldman and then the Corona crisis happened, the PMs, they were meeting every single day. And on the fixed income side in particular, they didn't look at indices, they didn't look at single bonds, they looked at the ETF prices for things like emerging markets, high yield, and other more esoteric fixed income asset classes. Because of this liquidity ecosystem within the ETFs, the ETF price is the best tool for price discovery. And I think this is something which will happen for tokens as well, because there are so many players on the DeFi side which have pricing capabilities. If you bring this all together in a secondary market facility, for example, you can make this a price discovery tool, which is not just through our trading hours, but really 24/7. So that's why I really think that over time, tokens will be absolutely additive to the global liquidity footprint of securities, and this will be their biggest strength over time.
So I guess it's drawing the conclusion from that, it's fair to say that the ETFs have shouldered a lot of the burden in terms of educating and demonstrating to the regulator that this kind of, maybe not a derivative asset, but a more liquid representation of pricing of otherwise liquid assets to get them comfortable with that. So that could maybe help tokenization move forward a little bit more quickly, or do you think it'll be like a 10-year timeline like we saw in ETFs? And if so, when did the clock start? Did it start this year, last year, or 2017? Or
I think, from my perspective, and I will have a view on this as well as others, I think ETFs are definitely a stepping stone. And so I think we also need to think about just what's happening at the top of the house in asset management firms today and what's happening from a C-suite engagement perspective. Is tokenization priority 1, 2, 3, 4? It may not be. Why is that? Because I think every asset manager is focused on what's their AI strategy and how do you use AI in portfolio manager. Everybody's looking from a security perspective in terms of crypto and how you, not crypto, and cyber protection, how you protect yourself from a cyber perspective. But there's also a huge arms race taking place in asset managers today about trying to wrap your active capability in the ETF. And then what can you do about private assets in the ETF? So I think those steps at the top of the house are still very much the big priorities. Once maybe some of those have got more traction, particularly the private assets and the active capabilities, then I think you'll see maybe more top of the house engagement around tokenization and how can we take these ETFs that we now have. We see all this powerful technology in blockchain space and tokenization space, particularly from a cost and distribution perspective. How do you start to bring that together? And I do think it'll get there, but for today, I think there's maybe some higher priorities at this stage. I don't know if you'd agree with that.
Well, I do agree with those priorities, but I would also say that, let's go back to the have wallet ecosystem players. We're really talking about hundreds and hundreds and hundreds of millions of users all over planet Earth that already adopted this. It's a rapidly growing distribution opportunity. We believe that likely this ecosystem of have digital wallet actors and platforms will get permissions to operate in the securities related businesses faster than the want wallet ecosystem will get the wallets, quite frankly. Right. And so it represents just massive new customers, and everybody wants new customers. I think a big watershed event could occur if the SEC begins to agree to allow for third-party distribution of what they call digital asset securities. Benji is considered a digital asset security. It's just a security riding on blockchain rails. That's a very narrow thing, and the Trading and Markets Division of the SEC has not yet allowed for third-party distribution of digital asset securities. But when that breaks, what's going to happen is all of these have wallet ecosystems that have had these underlying securities-related businesses that they've owned, that they'll operationalize, they'll immediately be able to distribute securities. And that's going to be a watershed moment for the asset management business in general. They're going to wake up and they're going to say, oh my God, how can we reach these customers, by and large?
So,
right on clock.
Right on clock. Any final comments, views before we wrap it up? We're at time.
My final comment is I think it's super exciting times for real-world assets within tokenized form. I think there will be a very bright future for this asset class.
Yep. Great. Thank
Use
you,
case
everybody.
and investor education.
Thank you.
Thanks, everybody.
Thank you.